So, you're thinking of investing in gold but don't know what to buy. Let's be clear about one thing. Gold is a classic investment choice. Most financial experts recommend having a chunk of your portfolio dedicated to gold. Now, the real question is, how do we invest in gold? You could stick to traditional physical gold, or you could go for one of those newer gold ETFs. Some people swear by physical gold, believing that if you can't touch it, you don't truly own it. Then there's the other group who are perfectly fine with investing in a good ETF. Who's taking the bigger risk? Let's break it down and see which one is better, physical gold or gold stocks. First, let's break down the basics of investing in physical gold. So, what exactly is it? Well, it's simply gold in the form of coins or bars, available in different sizes. You can buy it from trusted dealers or online. Just be sure you're getting the real deal. Now, on to the perks. Physical gold is tangible. You can hold it and stash it away securely, which offers peace of mind. Plus, it tends to hold its value during economic uncertainty, making it a popular hedge against inflation. And since supply is limited, its value could increase over time. It's a great way to diversify your investment portfolio. But there are downsides too. Storing and insuring gold can be costly, and selling it quickly might not be easy. Plus, there's the risk of theft or damage, and its value can fluctuate. Now, let's talk strategies. You can go for the classic buy and hold approach, steadily buy gold over time, or diversify across different assets to minimize risk. Now, let's talk gold stocks. These are stocks of companies involved in mining or exploring for gold. The prices of gold stocks can swing based on a bunch of factors, like the price of gold itself, company news, and broader market trends. Investing in gold stocks has its perks. You might get higher returns compared to physical gold, and buying and selling is a breeze. But there are downsides too. Think company-specific risks and the potential for underperformance compared to physical gold. So, to get some gold stocks for yourself, you'll need to open up a brokerage account and make your purchase through them. Simple as that. Now, when it comes to investing in gold stocks, there are a few strategies to keep in mind. First up, diversification is key here too. You don't want to put all your eggs in one golden basket, so spread your investments across a range of gold stocks. Mix it up with big-name companies and smaller ones, and consider different regions too. Next, there's fundamental analysis. This involves digging into a company's financials to see if it's worth your investment. Check out things like cash flow, debt levels, production, and reserves to spot undervalued gems or companies with serious growth potential. And hey, if you're looking to invest in gold stocks in India, you're in luck. India's gold market is huge, and its domestic mining industry is growing fast. You've got plenty of options when it comes to companies involved in gold mining, exploration, or production. It's a great way to tap into a booming market and diversify your portfolio. Let's weigh up the pros and cons of investing in physical gold versus gold stocks. Physical gold has its perks. It's tangible, so you can hold it in your hand and store it wherever you like, giving you a sense of security. Plus, it's historically been a solid hedge against inflation and currency devaluation, with the potential for its value to appreciate over time. But there are downsides too. Storing it safely can cost you, and selling it quickly can be tricky. Plus, there's always the risk of theft or damage. Now, onto gold stocks. They offer some enticing advantages, like the potential for higher returns, especially when the demand for gold is soaring. Buying and selling is a breeze through a brokerage account, and some gold stocks even pay dividends, giving you an extra income stream. But there are risks to consider, like company-specific issues, such as management problems or operational issues that could affect your investment. Sometimes gold stocks may not perform as well as physical gold, particularly when demand for gold is low. Plus, like all stocks, they're susceptible to general market risks. such as economic downturns or changes in interest rates. So there you have it, the ins and outs of physical gold versus gold stocks. It's all about finding the right balance between tangible security and potential returns. When you're torn between going for physical gold or diving into gold stocks, it all comes down to a few key factors. First off, think about what you're aiming for with your investment. Are you after something solid you can hold onto for dear life? Or are you more into the idea of potentially scoring big gains in the stock market? Your risk tolerance and how diversified you want your portfolio to be also play a big role here. Let's break it down with some real-life scenarios. Say you're feeling jittery about the global economy and want something super safe to stash your cash. In that case, physical gold might be your go-to. But if you're eyeing up a specific gold mining company that's got its ducks in a row and looks to set soar, you might be better off diving into gold stocks. And hey, let's not forget about gold shares, aka exchange-traded funds or ETFs. These puppies offer the perks of easy trading and liquidity, but they come with their fair share of fees and potential hiccups in tracking performance. So, before you jump in, make sure to do your homework on the specific ETF's management style and track record. These investment funds track the price of gold and trade on stock exchanges just like regular stocks. The beauty of ETFs lies in their convenience. You can invest in gold without worrying about storing physical gold. Plus, they offer liquidity, easy trading, and lower fees compared to dealing with physical gold. With gold ETFs, you can also benefit from gold price movements without needing a hefty investment. However, there are some downsides to consider. Unlike physical gold, ETFs aren't backed by the actual metal, and you don't directly own any gold. Instead, you own shares in a fund that holds gold. This means if the fund faces insolvency, your investment could be at risk. ETFs aren't the only type of gold stock either. There are also gold mutual funds and gold futures. Confused? Let me explain. Gold mutual funds offer investors diversification and professional management, making them a solid choice for those new to the gold market. But they come with their drawbacks. These funds charge management fees, which can eat into your returns, and their performance relies heavily on the skills of the fund manager. Gold futures, on the other hand, are agreements between investors to buy or sell gold at a set price and date in the future. They offer leverage, meaning you can control a large amount of gold with a small capital investment. But they're risky and require a deep understanding of the gold market, as well as previous trading experience. Plus, there's the potential for margin calls, where you might need to deposit more money if gold prices move against your position. Okay, so we've explored various ways to invest in gold, from physical gold to gold stocks, and alternative methods like gold ETFs, mutual funds, and futures. Each avenue has its pros and cons. Physical gold offers tangibility and can act as a hedge against inflation, but it comes with storage stocks and other risks. Gold stocks offer the potential for higher returns and ease of trading, but they're also exposed to market risks and company-specific issues. It's crucial to assess your investment goals, risk tolerance, and portfolio diversification before choosing between physical gold and gold stocks or exploring alternative methods like gold ETFs, mutual funds, and futures. Whichever route you choose, make sure to do your homework and consider your options carefully. And hey, if you found this breakdown helpful, why not give us a like and subscribe to stay tuned for more investing tips. Happy investing!